Internal controls over financial reporting are a critical element of ensuring accuracy and transparency in the financial statements of publicly traded companies. ICFRs are a direct result of the accounting scandals of the 2000s. Companies like Enron use complex accounting tricks like special purpose entities, while hiding debt with off-balance sheet transactions, and WorldCom capitalized expenses to overstate profits, deceiving investors and leading to huge collapses. SOX was passed to prevent these same situations from happening again by demanding greater accountability and transparency from management. And Section 404 of SOX specifically requires management to establish and assess ICFR with the goal of preventing errors and fraud in the company's financial transactions. When investors, lenders, or regulators look at financial statements, they assume those numbers are reliable. Internal controls are the systems companies put in place to make that assumption reasonable. They're supposed to prevent or detect errors and fraud before financial statements are issued. But here's the problem. Accounting scandals also happen at companies that have internal controls. So today's goal isn't just to define internal controls, it's to understand why they matter, what they're designed to do, why they sometimes fail anyways, often because of human behavior, pressure, or management override. Internal controls are the policies and procedures a company uses to help ensure its financial information is accurate and reliable. From a practical standpoint, they exist because the people using financial statements, investors, lenders, analysts, and regulators, are not inside the company. They rely on these numbers to make decisions about buying stock, extending credit, or evaluating management performance. Internal controls help reduce the risk that errors, manipulation, or fraud make their way into the financial statements. And they do this by either preventing problems from occurring in the first place or detecting them before financial statements are issued. So it's important to understand, though, that internal controls provide reasonable assurance, not absolute certainty. No system of controls can completely eliminate risk. Controls are designed, implemented, and monitored by people, and people can make mistakes, exercise poor judgment, or intentionally override controls. When internal controls are weak, the consequences can be significant: misleading financial statements, loss of investor confidence, regulatory scrutiny, and in some cases, financial restatements or fraud. That's why internal controls are a critical foundation of financial reporting, auditing, and corporate governance. Because of how much is at stake, companies don't design internal controls casually. They follow a structured framework that defines what effective internal controls actually mean. So let's look at the regulatory framework that guides the establishment and assessment of internal controls, particularly for publicly traded companies. This framework includes COSO, PCAOB, and SEC, and each plays a crucial role in ensuring robust internal controls over financial reporting. COSO, or Committee of Sponsoring Organizations, provides the internal control framework widely adopted by companies worldwide. The COSO framework outlines 5 essential components for designing and maintaining effective internal controls, which we'll discuss when we look at internal controls over financial reporting. The 2013 COSO framework is particularly influential in guiding companies on how to assess and improve their internal control systems, including ICFR. Now, the SEC, or Securities and Exchange Commission, enforces financial reporting standards for public companies. Under the Sarbanes-Oxley Act, companies are required to assess and report on the effectiveness of their internal controls over financial reporting in their annual filings. The SEC ensures that companies follow these regulations, helping to maintain transparency and accountability in financial reporting. PCAOB, or Public Company Accounting Oversight Board, oversees the auditing profession and sets auditing standards for public companies. In particular, the PCAOB ensures that auditors evaluate the effectiveness of a company's internal controls over financial reporting as part of their annual audit. This includes auditing the design and operational effectiveness of ICFR and reporting on any significant deficiencies or material weaknesses. Each of these organizations contributes to the regulatory environment that ensures internal controls are both properly designed and effectively implemented. To this point, we've talked about internal controls broadly, controls over operations, compliance, and reporting. Internal controls over financial reporting, or ICFR, narrow that focus specifically to controls that impact the financial statements. ICFR is concerned with whether transactions are authorized, recorded accurately, and reported in accordance with GAAP. In other words, ICFR exists to help ensure that the numbers you see in the financial statements are reliable. Not all internal controls are ICFR. For example, controls over employee safety or production efficiency are important, but they don't directly affect financial reporting. Auditors don't evaluate those as part of ICFR. ICFR is treated differently because of what's at stake. Under Sarbanes-Oxley, management must assess the effectiveness of ICFR, and for public companies, external auditors must evaluate and report on those controls as well. When auditors identify a material weakness, they're saying there is a reasonable possibility that a material misstatement of the financial statements could occur and not be prevented or detected on a timely basis. That's why ICFR receives so much attention from regulators and investors. This is worth remembering because it clears up a common confusion. Management, not auditors, is responsible for designing and maintaining internal controls. The SEC doesn't design controls and doesn't audit them. It requires companies to have effective controls and enforces compliance when they don't. Auditors don't create controls either. They test what management has designed following standards set by the PCAOB. When something goes wrong, understanding who was responsible for what helps explain accountability and financial reporting failures. Next is the Board of Directors and Audit Committee. The Audit Committee, which is typically a subcommittee of the board, has oversight responsibility. They must ensure that management is taking the necessary steps to maintain effective internal controls and ensure compliance with legal requirements. The Audit Committee also monitors the work of internal and external auditors and reviews the company's internal control reports. The auditor's roles are next. External auditors test the company's internal controls over financial reporting as part of their annual audit. They assess whether the controls are designed and functioning effectively and report any findings to the Audit Committee and shareholders. Internal auditors, if the company has them, conduct ongoing monitoring of the controls to ensure they're working as intended. They may also recommend improvements to management. In short, while management holds the primary responsibility for the design and operation of internal controls, auditors, both internal and external, provide independent assurance about the control's effectiveness. When auditors test internal controls, they focus on two things: design and operation. First, design effectiveness asks whether the control, if followed, would actually prevent or detect a material misstatement. A poorly designed control can't work, even if employees follow it perfectly. Second, operating effectiveness asks whether the control is being performed consistently and by the right people. A well-designed control that isn't followed is still ineffective. Auditors don't test every control. They focus on controls that address areas with a higher risk of material misstatement, such as revenue recognition, payroll, or inventory. If a key control fails in either design or operation, that failure can rise to a control deficiency, a significant deficiency, or a material weakness. Even well-designed internal controls have limitations. They're operated by people, and people make mistakes, exercise poor judgment, or intentionally override controls. Collusion is especially difficult to prevent because controls often rely on segregation of duties. When individuals conspire, those safeguards break down. Management override is another significant risk. Senior executives may have the authority to bypass controls, which is why tone at the top and governance are so important. Finally, controls are subject to cost-benefit constraints. Companies must balance the cost of implementing controls against the risks they are designed to address. This is why internal controls provide reasonable assurance, not absolute certainty, and why professional judgment remains critical in accounting and auditing. Internal controls over financial reporting are a critical element of ensuring accuracy and transparency in the financial statements of publicly traded companies. It's not a one and done kind of project, but an ongoing commitment by management to provide reasonable assurance that fraud does not occur in financial statement processes.